The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is tax season. And all of our offices are open starting next week, 9 to 9. We're open tonight, 9 to 5. You can talk to a real human being, and if you have questions in the middle of the night, you can get up and go to EG Tax and ask the tax lady and ask your question, and I'll get up in the middle of the night and answer it. So we want to help you. And this is Tiffany Fabian. Hey, Tiff.
Hey there, Esther. You really get up in the morning at the middle of the night, so there you go.
Well, I'm really not a late sleeper. I'm like a 4 o'clock in the morning kind of person, you know? So if I said to her I slept in today, I slept in at 4:30. So I'm Esther Gulius, the tax lady from EG Tax. We have 32 area offices, 33 area offices to serve you. Brand new office in Orchard Park. You should be getting your forms should be rolling in. You want to make sure you wait for those forms. I know that a lot of people think that you can file your return without your W-2. You can't. You cannot file your tax return without the W-2. You can get started, and put all the figures in that you think is going to be on the W-2, but you really can't. You can't file until you get that W-2. So those are all coming in. We are going to talk on our series here. We're going to kind of walk through the tax return and help you to learn what each part of the tax return means so that you can make sure that you don't overpay your taxes. It's just wonderful to have an opportunity to serve people, though. What's one of your little things that happened today, Tiff?
So today, one of my clients, I've been doing their return for a long time, and it's a married couple, and they make together $34,000, and so they don't have health insurance. And so we put $7,000 into an IRA, and then they'll qualify for the essential plan, which is $20 a month. So it's a double win. They're going to get health insurance that they didn't have, and they got the retirement savers credit. They do not; their kids are grown,
okay,
and so they'll get the retirement savers credit, and they get health insurance for $20 a month, and so that was a win-win.
That's great.
Yeah.
I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930. I had a couple today that came in, and he's working full-time, and he's a senior.
Right.
And he was kind of complaining that he had to go off the essential plan, and he's having now to pay for his health insurance through Medicare. Mm-hmm. And I said, well, where's your Social Security statement? And he said, oh, well, I can't collect Social Security because I'm working. And I said, no, once you're normal retirement age, you can start collecting your Social Security. He said, but don't I have to quit? And I said, no, you get to collect Social Security and your wages. So he was very happy. It's wonderful because it's not like all we do is taxes, although that's what we do. But because of so many other things that affect the tax return, it's like putting together spaghetti sauce. You got all this stuff that makes the sauce.
Right.
And so that's what's really important. And you want to make sure that you plan. Another couple I had today, I said, now you have a child that turned 17 this year. So your child tax credit goes from $2,000 down to $500. Mm-hmm. Is your child going to school next year? And they said, gee, we really don't know. And I said, well, then what's the problem is you're going to lose the $500 altogether. And you guys used to get the earned income credit. So we talked about all the money that was going to change. And so it's important that you know not only what's happening this year, but planning for next year.
Yeah, another one of my clients, I've been doing her return for a long time, and she gets a little tiny bit of Social Security. You mentioned Social Security every month. But I said to her, if you call Social Security, and she was married to her husband, they got a divorce for 12 years, you can draw upon his Social Security. And so she got a $600 raise every month in Social Security because she's
using her
figure.
husband's Social Security.
Right, and she had no idea if she was married for more than 10 years.
And I will tell you, Social Security, I know Mike Hayflick is the Social Security claiming strategist from the Financial Guys, but you can call the Social Security and they're very approachable, and talk to them about planning to
Right.
collect Social Security and all the different options. All right, we wanted to talk again, 8030930, 8030930, star 930 on a cell phone. We want to talk about wages. Everybody understands they got to pay taxes on wages, but taxes on wages means that you're paying, you get really no break for wages at all. So it's up to you to create the break. And one of the best ways of getting a break for your wages is to put money into an IRA or the pension plan for your employer,
Right.
especially if the employer does a match.
Yeah. Yeah.
So if the employer's doing a 3% match
Or a 6%.
and your wages are $50,000, that means that the employer would put in, if you put in $1,500, the employer puts in $1,500. If you aren't in that plan, you're effectively throwing away that employer match.
I like the way that you said that. So the wages, there's no special treatment, so it's up to you to make a special treatment.
Right.
That was
Because
really
otherwise
well
your
said.
wages are going to be taxed as ordinary income.
Right.
So the first thing you want to do is look at getting into the pension plan, even if it's a little bit, because there's such a thing called a pension savers credit.
Right.
How does that work, Tiff?
The pension savers credit is done on the form 8880, and it's based on if you put money into a 401k
Or an IRA.
Or an IRA. If your income is a certain amount, if you're a single person or a married couple, a single person, I think your income has to be below $27,000. If you're head of household, your income has to be below $37,000, $38,000. And if you're a married couple, so your income is on the moderate to low side, and then you get a percentage of the amount that you put into your 401k or IRA, and it's a credit that
It reduces your tax liability
reduces
dollar
your
for
tax
dollar.
liability.
In
which is
some
great.
situations, it's 50% of what you put away.
Right.
So can you imagine you put away, I mean, that would be like the bank saying, we're giving you 50% if you put money in a CD. There would be a line a mile long to get into that deal. And the federal government, as part of your tax liability, lets you do that, and they'll let you do it up till April the 15th. So if you didn't put money into your IRA, you can do it up till April the 15th if you had wages, and you may qualify for not only the reduction in your wages, but it could increase your earned income credit, and you may get the pension savers credit.
That's right. And the example that I talked about earlier, it entitled people to get the essential plan coverage.
And the health insurance thing.
Another
Yep.
thing that we've been doing is there's a increase in your Medicare. It's called IRMA. And so if there was a discrepancy in your income, you had a higher income one year than you do this year, we can type up a letter and ask for Social Security to not increase your Medicare.
All right. So those of you that are getting an increase in your contribution to Medicare because you had maybe an unusual situation, maybe you sold a rental property, maybe you hit the lottery, and it's unusual that this would happen, we can help intercede so that your Medicare portion that they're now taking out, that because you got the extra income, they will make an exception if there's a reason why you had an abnormally high income level last year, and instead of them increasing your Medicare, we can help you to get out of that too.
That's right. We do it all the time. And
Right.
usually they say yes, which is great.
Right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930, and you can text us at 3930, and we're going to start off with Bob from Niagara Falls. Hey, Mr. Bob, how can we help you, sir?
Hello, I got a rental property.
Okay.
I'm trying to find out if the taxes on the rental property are tax deductible and the repairs are tax deductible.
They sure are. As long as you're trying to make money on the rental property, you're not renting it to your children below fair market value or your aunt or uncle or whatever. But as long as you're renting it at fair market value, then all of the expenses that would have been deductible prior to the change in the tax law last year is still deductible. So yes, it's deductible.
So what about the utilities like the water?
If you're paying the utility for the tenant, yes, it's deductible.
Okay.
And don't forget, if you're in the business of being a landlord, there's a 20% pass-through credit that you're entitled to. So I
But
don't
you
know.
can't commingle the funds. And so if you're making money on your rentals, like for instance, one of my clients has like 80 rentals, and he makes about $200,000 a year after all of his expenses. He is in the business of of managing and renting property. So on his $200,000, he gets a pass-through deduction of 20% of that, or $40,000 against his other income. You, as somebody that's a landlord,
QBI.
if this is a business that you're conducting, you're not commingling funds, and it's really a business, then you should look at the pass-through deduction as well.
Okay, it's just a house that I moved out of, moved in with my...
Okay, well then in that situation, you wouldn't opt for the pass-through.
But you would still get to deduct possibly
But all your expenses are still deductible.
the fixing, the repairs, the
Okay,
property
Bob?
taxes.
Now, if I sell this house,
Yes.
to worry about capital gains, the house is valued at $70,000.
All right, so how long have you rented it for?
I rented it at, I'm sorry, 5 months, and I had problems with the tenants after that.
All right, so you only had it for 5 months last year?
Yeah,
And prior to that, you didn't rent it?
I lived there. It was,
All right, so you just converted it. So at the time of conversion, if the adjusted basis was 70, your depreciation is going to be about $2,100. If you sell it next year, then all you're going to have to do is pick up the difference between the 70,000 and whatever you pay for, whatever you sold it for, less expenses. So yes, you're going to have some capital gain, but not very much. And if you're not going to keep it being rental property, if you're going to convert it back to business, it's something you want to think about on how you do your return this year.
okay, very good.
Okay? Thanks, Bob.
You have a good day.
You too. Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on the cell phone. We want to talk to you about your taxes. Text us at 3930. We're going to take a short break, and we'll be back with your calls on the other side. That's what we think, your family. And I'm the mama. I'm Esther Gulius, the tax lady from EG Tax. If you would like to have your tax questions answered, give us a call at it's 8030930. You can text us at star 930. And no, you can. Let's try that again. My phone number is 8030930. You can, or cell phone star 930, or you can text us at 3930. And we have Sue, who's been waiting. Hey, Sue, how can we help you?
Hi, Esther. How you doing?
Good.
I maxed out my 401k,
Good for you.
TX. I also maxed out my catch-up,
Good for you.
and they also took out like $2,500 extra because I can't quite get the percentage just quite right
Sure.
after tax. So can I claim that after tax anywhere contribution?
So you've put the maximum in, right? You can't take more than the maximum.
Okay. All right. I wasn't sure. Like, maybe if I take it out of there and put it into.
Well, actually, they should.
Right.
So isn't your employer managing the account?
It's kind of up to me to manage.
Okay. Well, you have to take it out before April the 15th, and it's not going to be taxable. But it's not deductible. And actually, if you leave that extra in there, you're going to have a penalty.
Penalty on it, yep.
Really?
Yeah, you're not allowed to put more in.
This is after tax.
A Roth?
Are you talking about a Roth?
The extra, like $2,500 is after tax.
No, hon. You cannot put in more than the maximum amount. So if the maximum amount is $25,000 and you put in $27,000, you can only put in $25,000. If you put in an extra $2,000, you end up with a penalty.
Okay.
You got to take it out. Okay?
Yep.
And call
All right.
if you have questions.
Yeah,
we can
call
help
us
you.
and then we can talk specifically.
632-7886.
All right, Sue, thanks for calling.
Thank you.
Bye-bye. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on cell phone, and you can text us at 3930, and we got John in Amherst. Hey, John.
Yes, good afternoon.
Hi.
I have a scenario where there's a 63-year-old person collecting Social Security.
Okay.
They have a $17,000 plus a year maximum without being penalized.
Okay.
Now, if they made $3,000 more and put it in an IRA, would they still be penalized?
Okay. No. It's actually $18,350 this year, there and abouts. Okay. So,
Yeah.
Okay, so if they made 20, they can put money into their IRA once it's FICA wages. So if they're FICA wages, they're going to be 20, then they're going to have to pay back the dollar for every $2 over.
So to answer your question, no, putting IRA money in does not circumvent that limit.
Right.
Okay.
Esther taught me that many
All
years
right.
ago.
Thank you very much.
All right, thanks, Sean.
Good
Bye-bye.
question.
Okay, and all right. And again, if you have any questions, we got some.
Yeah, there was a text. It says, if Chris Collins and the others would have taken their loss, could the loss have been deductible on their taxes, and could have they lived happily ever after? So they could have taken $3,000 a year.
Well, here's how it works. I'm obviously insider trading is a big no-no, but had they not done insider trading and had the loss, and let's say the loss was $1 million, they could have used dollar for dollar that loss against any other gainers in the capital gains that they had. So if they had other stocks that had $1 million gain, they could have offset the gain on the $1 million gainers with their $1 million losses and taken it all at once. If, however, they didn't have any other stocks or any other capital assets that would have been that would have had a capital gain, then that loss would have only been used up to $3,000 a year against their other income. So that would have kind of gone on for a long, long time until their death, actually. Mm-hmm. So if you do have losers, you can offset the losers against winners in the capital gain arena. Other than that, it's whatever losers and winners you can net against each other plus $3,000 until it's used up.
Well, yeah, and it would have been cheaper with all the fines and legal
That's
fees.
True. Hindsight is always 20/20.
Yes, I said that to a client today. Yeah, it is.
Okay, and then what's the other one? ER after?
Oh, that's the rest of that text.
Oh, okay,
Happily
gotcha.
ever after.
I'm Esther Gulius, the tax lady from EG Tax, 8030930.
There is another text.
8030930, star 930 on a cell phone. And what's our next text?
What is the income level for someone retired and over 65 to file for 2009 taxes?
Married or single?
Well, Marianne didn't say. So, Marianne, we need to know if you're married or single, or if you have children or dependents. So if you're single, though, it is so 12,000.
It'd be 12,400, so it'd be 20. It'd be 13,500.
13,500
before you'd have to file if you're single, and it would be 24,400 plus so about 27,000 if you're married filing a joint return.
So
if you don't have credits.
Yep.
Okay.
Yep. So good question, but don't forget you want to file if you have any withholdings.
And that's
regardless.
the other thing is, don't be tricked into thinking just because you don't have to file that you shouldn't file, because many times there's withholding. Or if there's no withholding, if you're between the ages of 25 and 65, you could get an earned income credit even if you don't have children. So there are many people that file just to get the money back.
I was doing somebody's tax return, and they used a free site, and they put the income in the wrong places, and they're getting audited. We have to go down to Elmwood. But then they also gave me their kids' return, and their kids were claimed as a dependents, but they had all these withholdings. So I did their tax returns today, the kids' ones.
So. And that's the other thing, that does a kid have to file if he made less than $12,000? No, he doesn't have to file. Should he file? He's got withholding. Yes, he wants to file. And on the state of New York, he's going to have to pay, right? Mm-hmm. Let's go back to the phones, and we're going to go to Ed. Hi, Ed. How are you, sir?
Sir, I'm fine. I have two questions. First of all, where do you indicate on Form 1040 interest rates that you earn from cashing in Series I savings bonds?
They don't care about your interest rate. They only care about the interest received. So if you have $1,500 or more in interest accrued from bonds that you cashed in, then that goes on the Schedule B. And don't forget, on the state of New York, it's taxable on the federal, but on the state of New York, it's a subtraction.
Then what do you put on, for example, Form 1040, line 2A?
Okay, read me what line 2A says, Ed.
Oh, I don't have it in front of me. Something about...
I'm going to try to look.
I don't have the form numbers. I don't have the form memorized by numbers. But if that's where the interest is, that would be the interest from your bonds. That's about where it would be.
That's what I'm thinking.
That would be where the interest from your bonds would go. But if is it more than $1,500?
No, I'm really just interested basically in the Series I bond interest.
Yeah.
Did you cash it in, Ed?
Yes.
Is the interest over $1,500?
Yes, it is.
2A is
All right.
exempt
So 2A is tax exempt interest. You don't have tax exempt interest. Tax exempt interest would be municipal bond interest.
Oh, municipals. Okay. And also, Esther, what is the mileage rate allowable for operating expenses when you use your car for medical reasons? Is it 20 cents?
It's 20 cents.
Okay. Thank you very much.
All right. You're very welcome. Thanks for calling.
My pleasure.
Okay. And
Good
we're going to go
questions.
to Josie. Hi, Josie. How are you? How can we help you?
Good. Hi, Esther. I have a question about student loan interest.
Yeah.
I am paying for my daughter's student loan, but I don't claim her.
And so
Are you signed on the loans?
There you go.
I co-signed the loan.
Okay. And so she's not going to take it herself because they consider it if the parent's paying, they will allow the child to take it or the parent, whichever. So you both can't take it though.
But
I
what
got
if
a
you
break
could?
for news, Josie. I'll see you on the other side. Bye-bye. I'm Esther Gilius, the tax lady. We'll be on the other side of the news. We'll see you in a minute. Hey, family, this is Esther Gilius, the tax lady from EG Tax. All of our offices are open today, 9 to 5. Monday, starting 9 to 9, we're in there. We're in there all the
There's
time.
a mall office open tomorrow if you wanted to at the
Oh, the
McKinley,
McKinley Mall. Right,
Yeah, yep,
right.
I was there last weekend.
The thing is, if you don't have all your documentation, really wait. I know everybody says hurry up and file, but you can't file without the correct information. You know.
Yep.
So you don't want to file. You don't want to file late because there could be identity theft. But more than anything, if you don't have all your stuff, you got to file with all those forms with all the information that's correct.
Yep.
And you just can't file with your pay stub.
Right. There was with
Wanted
somebody.
to let that gentleman know that called before was the medical mileage 20 cents. It is in 19 and. In 20, it drops to 17 cents, and business mileage is 58 cents this year and drops to 57.5, and they keep the good old charitable the same. All right? Our phone number here is 803-0930, 803-0930, star 930 on a cell phone. And the other thing is, if you're somebody who's been performing services for an employer, and they haven't been taking out taxes, and then you find out you're getting a 1099, and they told you when to come, when to go. They gave you the stuff to work at. They gave you an hourly salary, and they didn't take out taxes. You need to go to that employer and say, you need to pay me on a W-2 because this is not right. And if the employer will not give you a W-2, you need to call New York State Labor Department because that employer is cheating. Mm-hmm. And he's cheating you, and he's cheating, and maybe they don't know. And we're very happy to help your employer. We'll help straighten them out. But I will tell you, the FICA, they should be paying for you. That you should have workers' comp if you're injured on the job, and and disability. You should not put up with it.
No, not
And
at
there's
all.
so many job openings. You don't have to work for somebody like that.
Nope.
Let's go back to the phones. We're going to talk to Mike in Kenmore. Hi, Mike.
Hello, good afternoon.
Hi. How can we help you, sir?
I had a question about the new W-4 form
Yeah.
that came out this year.
Yeah.
So I had to update it, and I don't know, I wanted to make sure I did it right.
Okay. Well, here's the thing. The W-4 is the guideline by which your employer withholds taxes. So if you strictly adhere to everything that's on that W-4, you're going to find out that they're going to withhold maybe less than you wanted withheld. Because really, at the end of the year, even though the IRS might say your tax bill is $4,000, and so therefore, ideally, all they're going to do is take out $4,000. So when you file your tax return, you get 0 refund and 0 balance due. That would be what they're shooting for. Maybe you as a taxpayer say, gee, I kind of like to get a $2,000 refund. So you might want to hedge a little on some of those deductions on your W-4
Mike,
because the more allowances you claim, the less they're going to take out.
Do you have any dependents under the age of 17, Mike?
Yes, I have 2 children.
So you're supposed to take those 2 children on, I think, Section 2 and times it by 2,000. So you're going to take 2,000 times 2, which is 4,000. And then are you married or single?
I am married.
Yeah. So then I think Section 3 is if there's more than 2 jobs. Do you and your wife both work?
No, just me.
Okay. So do you work 1 job or 2 jobs?
2 jobs, but the one is just a very small income compared to the other one.
Okay, so I know, so in Section 2, you're going to take, you're going to write $4,000. You're going to check married joint at the top. And if you work more than 2 jobs, you're supposed to do that extra worksheet. Now, it doesn't sound like
here's the thing, going back to what I was saying.
Yeah, but
it's still a guideline.
It is a guideline, of course, but I'm
Right.
giving him the other side.
That's true. But
Yeah.
here's the thing. If he really has to say to himself, do you like a refund, Mike?
Yeah, I usually get somewhere around 2 to 3.
Okay, so if you strictly adhere to that W-4 that Tiffany's walking you through, which is she's absolutely correct, you might find out that they're going to take out a lot less in taxes, and then you won't get your refund next year. So that's where I would suggest maybe you want to give Tiff a call, and she can go over your W-4 with you, and then say, okay, so if we do this and we claim 4, you're not going to get a refund next year. And if you're happy with that, that's great, but maybe we should look at 2.
The other part that is relevant is I have no idea how much money I'm going to make any given year because lots of overtime opportunities.
Right.
Oh.
So sometimes it just stops.
Right. Well, and again, the W-4 is not the tax return. The W-4 is the plan.
No.
So what you want to do is if you're and then you have to understand that the withholding charts are based on the fact of the amount of money you earned at that point in time. So if you have 6 allowances and you made $1,000, the chart's going to say something. But if you have 6 allowances and you make $8,000, the chart figure is going to have another figure. So it really is kind of flexible based upon the income you're making.
Have you switched jobs, Mike, or is this the same job?
No, same job.
So really, your employer is supposed to allow you to just continue with the old W-4, and it's like you could use a new one, but really you could just stick with your old W-4. It's an option unless it's a new employer. We called several payroll companies, and you don't have to fill out a new W-4.
Okay.
So
okay,
you
and
could use
again,
the old
if you
one.
want to, if you can do Fabian at egtax.com, and you can make a copy of it, and she'll take a look at it and call you back.
Okay. Well,
All right, Mike. Thank you.
Good
Bye-bye.
question.
Yeah, and that is, but to kind of give the broad brush, even though you can claim 7, you might not want to claim 7 because you may not get a refund.
Right.
And you might have a small balance due. All right, I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930. And, okay, the other thing is if you're an outside salesperson on a non-accountable plan, you have to go to your employer and go get on an accountable plan.
Right.
Because on a non-accountable plan, all the reimbursement that the employer gives you is going to be taxable income. The sad thing is you can't take the expense.
Right.
So you might have $20,000 in things that would have been deductible 2 years ago on a non-accountable plan because you're not submitting receipts to them. That's going to end up being income to you, and you spend it for the company.
Right.
So an accountable plan means you go to Mr. Employer and you say, Mr. Employer, here's my receipts from last month. He adds them up and says, oh, well, Tom, you get $3,000 from last month from those, and he writes you a check. That's not taxable. If Tom, though, you go in and you say, Mr. Employer, I spent $3,000 last month, and he doesn't make you give the receipts, and he writes you a check for $3,000, he has to include that in your wages, and you can't take that as a deduction, and that's a shame.
Except for on New York State.
Just on New York State.
Right.
Right.
And it is a shame. So have a conversation.
So if you don't understand accountable and non-accountable, we'll help you with that too. It's very important because you're really shooting yourself in the foot.
Yep.
Right?
And it's really easy for your employer to switch it.
If you're a household employer, let's say that grandma's sick and you have a nurse that comes in and they're not with an agency and you pay them more than $2,100, you have to do a W-2 for them and pay their FICA.
Mm-hmm. And so many people get this wrong. They treat them as self-employed when really they're supposed to be Schedule H household employees.
Right. And then, like we were talking about before, if you have children that are dependent upon you, either under the age of 19 or over the age of 19 and in school up till age 24 or disabled, and you have wages, you may qualify for the Earned Income Credit, which means that there's money like $6,000, $7,000 that they want to give you back that you didn't pay in, and the state of New York follows suit. If you're single, or not single, if you're married, filing a joint return, you're a senior, not even a senior. Well, seniors too.
Mm-hmm.
Between the ages of 25 up to 65, you could qualify for an earned income credit as well. Not as much, but it's still out there. And again, even though you don't have to file a return, there's money in there for you. And then the last part I wanted to say about W-2s is if you're missing or you have an incorrect W-2, you can fill out Form 4852 and attach that to your return. And the IRS, if you're using accumulated pay stubs, the IRS will honor that if you can't get a W-2 from your employer, because sometimes they go belly up.
Mm-hmm. Yep, after February 15th.
Right.
Yep.
Right.
That's right.
Good. Okay, let's go back to the phones. We have Tim. Hey, Tim, how can we help you, sir?
Yeah, hi. I have a house in which we bought as an old cottage, and I've added on, and it's our primary residency. And the intention was always that we were probably going to sell it someday and move out of the state. And then my understanding that any equity you had in that would then just come, transfer over to the new house. Well, now we're thinking of possibly moving out of state, and that house will then, at retirement, become a secondary home, not the primary home.
Right.
How do you handle the tax implications? Because it sounds like that up to this point, after 30 years of living in it, if I understand it correct, how do I not get charged for the capital gains?
All right. First of all,
doesn't become.
If anybody has a home that they've lived in 2 out of the last 5 years as their personal residence and they sell it as a gain, it's a tax-free gain up to $500,000 if you're filing a joint return, up to $250,000 if you're single. All right. So that's number one. So if you should sell it while it's still a personal residence, you're not going to pay any taxes when you sell it, Tim.
Yay.
Now,
okay.
The other thing is if you're thinking about moving out of state and you have a residence here, then you're going to have to make sure that you're spending less than half the year in your residence, or else New York State may fight you on the fact that you're still a New York State resident because they don't really want to let you go ever. Mm-hmm. Okay? So you have to watch that. And then the other thing is what happens is your personal home then would be converted to investment and it could become taxable. So you really ought to think about maybe selling that house while it's tax-free and maybe buying something less expensive and paying cash for it at a new appreciated value so you wouldn't have so much tax liability, or maybe just renting.
Yeah, but if you keep it and you go get another house, it's considered a second home,
Right.
and then capital gains
Right.
enter into the picture.
Right.
Right, because I could still, let's say you did the 50-50, let's say you went to Florida for 6 months back. But like you said, out of the past 2-3 years, I've done that. If I decide to sell it 5-6 years down the road,
Right. Then you get stuck with the gain on it. Whereas right now, if you sell it while it's still your personal residence, it's completely tax-free, and all you walk out with is a pile of cash.
right? I didn't know if there was a way that you could assess the value of it while you still owned it, had it appraised, because it's up.
Well, obviously, it's still going to be what you paid for it versus what you sell it for. But if you sell it right now as a personal residence, the whole gain up to $500,000, if you're single, if you're married, filing a joint return, is tax free. I mean, That's easy math.
Okay.
Okay, Tim?
Great. I appreciate your
Hey, thanks for calling. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break, and we'll be back on the other side with your questions. I got all my sisters with me. Hey, I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930. 803-930. Star 930 on a cell phone. Text us at 3930. We have all of our offices open. We want to help you. You know, we really try. And I mean, our best interest, you are in our best interest. You know, we want to bless you. I just can tell you that 100%. We just really want to help you. So, you know, from my heart to your tax return, I will tell you that. All right, let's go to the
text.
What do we got here?
It says, Esther, if you are a higher earner, $90K a year with no deductions, should you have a Roth or a traditional 401K at work?
Okay, so here's the thing. If you're married filing a joint return, you're going to be in the 12% bracket. With state of New York, you're almost at 20. So if you could put $7,000 away, for instance, in a traditional IRA, you'd save like $1,400, a little less than $1,400. So for 30 years, you would save, assuming you're younger, you would save $42,000 in taxes. All right. Now, then here we are, X amount of years down the line, and let's say that your only source of pension is what you saved, and you saved maybe $500,000. When you start taking it out, if the standard deduction keeps increasing like it is, the standard deduction might be $40,000, which would mean you could take $40,000 out with some modifications with your Social Security, and God knows what it's going to be like then, without paying taxes. So you'd be giving up $42,000 for the possibility of saving money on the back end, which you maybe never will pay taxes on anyway. So then if you're really a planner, you could start taking it out tax-free because the standard deduction would be so high. So it'd be a win-win. Now, that's the truth. Now, and God knows 30 years from now what they're going to have. They could be having sales tax rather than income tax, you know, and maybe we'd be in a socialist society and they say, you make it, send it here, we'll give you some more. I don't know what's going to happen, but I will tell you what I've learned in taxes is generally defer, and take every deduction you possibly can because they're going to change it.
I think a good indication when they just did the tax reform, they were almost going to take away the traditional. That was one of the conversations.
Oh, well, yeah, and they're talking about converting all those 401ks and sucking them into the federal government. So there you are, all these years, and maybe some of you did all Roths, and the federal government takes it on. So I mean, you don't know.
No, thank you.
You'd never know. My own opinion is take what you can when you can because they may just change it tomorrow, and they usually do. So if you got a crystal ball, let me know. Otherwise, we're going to Bruce. Hey, Bruce, how are you, sir? Hello, Bruce. Bruce. Going once, going twice. Bruce, are you there? Well, I don't know what happened, Bruce. We'll go to Bill. Hi, Bill. How can we help you, sir?
Hey, Esther. Just actually went to your place today again after years of going there.
Well, thank you.
Very good. Great people on Ridge Road there.
Oh, they are great people.
Hans and staff.
Yep.
Yeah, Hans, yeah. Great.
Isn't Hans great?
Always enjoyable, quick, and always refreshing on the amount you have to spend to get such great help.
Well, thank you, sir.
Quick question. It's been years. I was killed in 2009, 8, 9, 10. Florida lost quite a bit of money.
The housing market?
Hundreds of thousands.
Wow.
And back in Buffalo, and have not really checked into my credit scores. Looking to buy a house, I have $15,000 to $20,000 to put down. Don't really know my credit scores. Don't want to dip into investigating, without really knowing the best steps.
But Bill, just go to Credit Karma. Go to Credit Karma and just enter your social, and they'll tell you, they'll do your credit score right away, and you'll see if you've had any negatives and things of that nature.
Cross-state funding. Cross-state
Or,
funding.
and cross-state funding will help you too.
In
But if you want to know
Tonawanda.
your credit score,
There's
go
a
to Credit Karma.
There's a mortgage company we work with. It's Cross-State Funding. Her name is Kelly Palumbo, and her son, he's one of the top selling mortgage people in the area, and they'll check your credit, and they can actually help build your credit.
Right,
It's
but
called
if you want to know
Cross-State
in the
funding.
before you get there, you can go to Credit Karma. You can and just take a look and don't be afraid.
Call me if you need their phone
Yeah,
number.
don't be afraid.
And I should be able to get a good idea. If
You'll know. You'll know. And then Tiffany's absolutely right about
Cross-State
cross-state funding.
are phenomenal.
Yeah.
They will work with you to get your
And they
your
can
home.
help with your credit score. They've got tools. They're just great.
Okay, Bill?
When you were out in Amherst on Johns James, you did my mortgage years and years ago out there. I remember that because I know you're friends with a cousin of mine was in the jewelry business.
Wow.
That you know. I know you know him, but I'm not going to say the name.
All right.
I'm glad you're
well,
back
hey,
to Western New
again,
York.
call us if you need that cross-state funding information. But go to Credit Karma, okay, Mr. Bill?
You too. Bless.
Thank you, sir. Bye-bye. God bless. Okay, we're going to go to Joe. Hey, Joe, how are you, sir?
Oh, I'm doing real good. How are you, Esther?
I'm good. What can we help you with?
Well, I'm trying to figure out what my adjusted gross income is.
Okay.
After I take my exemptions,
There are no exemptions anymore.
okay,
So there's the standard. Are you single or married?
married,
So are you over 65 or under 65?
over 65.
All right. So basically, it's going to be 24.4 plus
1650 or something like that.
we're both sitting here. I got my calculator out here.
Plus 1650.
Just 24.4
And so that's
1350
10, 4,
is
5, 6,
26.
26.
It's about 26.7 before. Now, how much is what's your source of income?
I have a pension
And that's how much?
and Social Security.
How much is your pension, Joe?
A year.
Approximately 20,000.
20? And how much is your Social Security, yours and your wife?
Together, it's around about 42.
Does she have a pension too?
No.
Okay.
All right, so it'd be 41,000
I don't
minus
think they're
32.
going to pay any tax.
So we got 4,500. All right, so your taxable Social Security is going to be about 4,500 against your 20, so you're at 24.5. You're not going to have to pay any taxes.
Okay, but I was going to do the short form.
Well, you don't have to file.
Yep. Okay.
What I need you to do? Are you electronic at all, Joe?
Yes.
Go to my website at egtax.com, ask the tax lady, put in all your information, and email me, and I'll show you why you don't have to file.
You don't have to file.
Because this way I can make sure all the information's correct.
Your adjusted gross is zero.
It sounds like you should not have to file at all. But I don't want, you said you're about, and this is about, so let's get real figures, okay?
Okay.
All right, Joe, I'll talk to you later.
Thank you very much.
Bye-bye. Let's see, we're going to go to Linda. Hey, Linda, how can we help you?
Oh, hi, Esther.
Hi.
Denise.
Hello. Hey, Linda in Lockport.
Yes, hi. I'm actually calling for a friend of mine. When I heard last week about money in foreign banks, I have a friend whose mother died, and she inherited her house, and the house sold, and she currently, my friend, has $100,000 in a foreign bank in
Okay.
Canada.
All right, so she's got to do an FBAR.
Yeah. And so I told her that I heard it on the show, and she didn't know anything about it. She just was going to leave the money. She's going to leave the money in the Canadian bank in case she needs it later.
Okay, here's the thing.
She's not converting it.
Okay, nobody's asking her to convert it. The law says that if you have money in a foreign bank account, Canada's a foreign country to the United States, you have to fill out a form called an FBAR every year. If you have more than $10,000 in the bank, which she does, she doesn't have to convert it. She just has to let them know where it is and how much it is and what the account numbers are. And that's all she has to do. And if she needs help, she can give us a call. If she
Otherwise,
doesn't want
she's
to,
subject-
she can lose up to 50% of it.
And that would be silly.
That would be really terrible.
when I looked it up for the thing I found was that a statement about that you do not mail it with your tax return.
You don't. It's a separate form. It's a separate form.
But it's not sent to the IRS.
No, it's not. It's a foreign bank reconciliation that has to go to the Treasury Department. So this is something completely different. Okay, so it'd be a shame if she doesn't file it. If she doesn't, she's playing Russian roulette with her.
And we
with
do
her
them
money.
at the office all the time if she needs help.
Right.
At
If she needs help, we'll help her.
632-7886.
Yeah, I've been telling her that, but kind of hard.
You can
Well,
lead a
then,
horse to
then
water.
she may. That's right. I mean, we all have to accept responsibility for what we do or we don't do. So if she doesn't want to do it, it's up to her. Okay?
Good number for the FBAR, Esther.
It's called an FBAR. FBAR. FBAR.
That on the IRS?
If you go and Google it, just Google FBAR, FBAR, and you will find that it'll direct you right to the site.
Okay.
Okay? Yeah. All right, thanks, Linda. And then Steve, how can we help you, sir?
Yes, Esther, regarding inherited IRAs, I understand there were some changes according to 2020.
Yes.
That I heard distributions, RMDs. In the past, the IRA I inherited was designated my RMDs by my life now, my life expectancy. Is it true that that's been changed?
Not if you already had it in place. But new inherited IRAs are going to be based upon a 10-year payout as opposed to life expectancy unless you're the spouse.
I see.
Okay, and Steve, I just ran out of time. So you can go to my website at egtax.com. Talk to you later. Everybody who called, we want to thank you for your calls. Have a great week. If you need the best tax help, go to EG Tax. Thanks for listening. Bye-bye.